Equity Compensation 2025, India Trends and Global Best Practices. In this session, we are going to talk about India's evolving equity landscape, covering instrument mixes, options, RSUs, SARs, ESPPs, liquidity models like IPOs, buybacks, tenders and secondaries, direct versus trust routes, pricing, valuation, vesting, retention trends, and dilution coverage trade-offs, contrasted with global shifts. We would also talk about some benchmarks today. So for this session, I would like to invite Mr. Meetan Patel, FGE, Executive Committee Member at Global Equity Organization, and Aditya Pandey, Consultant at Capita. Meetan has extensive experience in both broad-based and executive compensation plans on an international level. Meetan was elected as a board member of the Global Equity Organization in July 2016 and has served as the co-chair of the Geo Provider Council. Meetan received a bachelor's degree in mechanical engineering from Brunel University in London and has held the ICSA certificate in employee share plans since 2003. So please put your hands together for Meetan. Our host for the segment would be Aditya Pandey, consultant at Capita. Aditya is a qualified chartered accountant with over 8 years of professional experience spanning external audit and asset management for global clients through his tenures at Deloitte and KPMG. Additionally, he was over 2 years of specialized experience in equity compensation solutions, offering comprehensive advisory across the design, implementation, and compliance of employee equity plans.
Okay, so first of all, thank you, Ravi, for setting up the tone for this event. Hello, everyone, and very good morning to all. I'm Aditya Pandey from Capita. So in this session, we'll talk about the trends and practices in around equity compensation across the globe. So firstly, I'll walk you through to the equity compensation trends and practices followed in India. And after that, we'll also have a pleasure to hear from Mr. Meetan Patel. Meetan will brief us or educate us around the global practices around the equity compensation. So, basically in Capita, every 2 to 3 years, we conduct a survey to understand as a professional what is actually trending in the market around the equity compensation. And based on that, we recommend to our clients accordingly. So the survey consists of 30 plus questions around equity plan administration, accounting, taxation, what are the scheme parameters, what are the grant practices have been conducted. So as we can see that the survey consists of the analysis of 250 plus companies, where the proportion of unlisted and listed is almost equal, where 139 listed companies have participated and 130 unlisted companies have also participated. Talking about the region and the industry type, so most of the contribution is coming from the financial service sectors, followed by the manufacturing sectors and the IT sector. There are many more sectors have been contributed like e-commerce, transport logistics, entertainment, pharma. And also, just to highlight that the most of the answers are received from the secretarial team and the human resource team, because these are the two departments which are involved to the most in the implementation and administration of the plan. So basically, these are the 4 key insights which we have retrieved from the survey report. So first is the disciplined equity planning. So this is all about that the company are now looking to actually strategize their grants while rewarding the employees. They are not just tenure-based rewards, but to strategize and link it with the performance milestone or the funding events. So the companies, 44% of the companies are granting under 25% of their grants and not exhausting their whole ESOP reserve while rewarding the employees. The second major shift or the major trend we have seen in this year report that now the companies are looking for the broader participation, that is granting ESOPs beyond the leadership level. So basically now 97% of the listed firms and 94% of the unlisted firms are looking to involve employees beyond the leadership level, like middle management employees, lower level employees as well. The third is the simplified and the performance-linked vesting. So this has been a greater shift we have seen in this survey, that now the company is moving towards the performance-based vesting rather than just time-based vesting, because while rewarding the employees, company are also looking to have a measurable outcomes out from the ESOPs. So to align the whole workforce, to align the company's objective with the individual objectives, company are looking to more have a performance-based vesting. The last one is the professionalization of governance. So basically, there are two routes where we can implement the ESOPs. One is the direct route, and the other one is the trust route. So through the trust route, we have to form a ESOP trust, and for the trust, we have to appoint a trustee. Now the company is looking to appoint corporate trustee or professional trustee rather than the individuals from within the organization, to have a transparency in the plan and to also give confidence to the employees that the plan has been managed independently and fairly. So we have understand that what are the key trends. Let's just talk about what is the first step in the equity compensation plan. So the question comes here, that why to implement equity compensation plan. The objective is continued to be the same, that retention and rewards are continued to be the primary drivers for the for the companies to introduce ESOP in their organizations, followed by attracting talent, followed by achieving performance target. And also talking about its effectiveness, so 96% of the companies, both listed and unlisted, have reported that they have either fully or partially achieved their objectives. So why ESOPs has been considered to boost retention and rewards? The answer is very simple, that retention and rewards only comes when there is no capping in the upside of the returns. The ESOPs brings no capping in the upside of returns, and we can have a sky is the limit for the value creation of the employees. The second slide is all about the grant practices, which is trending in India. So we can see that both listed and unlisted space, most of the companies prefer to grant ESOPs and RSUs as a instrument to the employees, rather than giving multiple instruments like SARs and phantom plans. The reason behind is that ESOPs and RSUs gives the real equity to the employees, rather than giving the uncertainty in case of SARs and giving only the appreciation in form of cash. Because the purpose of ESOP is to give ownership as well as the value creation. So the most preferred instrument is ESOPs and the RSUs. Whereas in the non-dilutive structure, companies can also go for the SARs or cash settled instruments, because they have to they don't have to dilute the equity and also settle the appreciation in cash. Now this is one of the major slide and the trends we have observed in this study, that is the employee coverage. As we can see in the unlisted space, the major proportion is going to 31% of the companies going to cover the employees up to 10% of their total workforce, which is decreased from year 22 survey. The 42 companies from 31% are only preferring to grant up to 10% of the population. But we can see an increasing trend here, that now 31% of the companies are covering more than 50% of their workforce. The reason is very simple. The shift is being noted that they are going with exclusivity to inclusivity. Because now the company is wanting to include more and more employees to align the ownership structure, and also if we want to bring results, if the company wants better results in the company, they have to align the whole workforce as well. Rather than giving equity to the individual sitting at top of the hierarchy, doesn't bring better results. If we want to have a better result, then you have to achieve the departmental targets, also the individual targets, which is coming from the middle level management and the lower level management. Also in the listed scenario, we have seen a decreasing trend in the leadership level grants, that 49% of the companies only granting up to 10% of population, whereas 18% companies have preferred to grant above 50% of their workforce. Okay, so this is all about the route of implementation. We discussed that there are two routes available to implement ESOPs. One is the direct route and other one is trust route. So majority of the companies go for the direct route because this is very simple to administer, not complex, and there will be no over compliances of the trust route. But we can see that there's the gap between the direct route and the trust route has been narrowed over the years. In the unlisted space, where in 22, 10% of the companies only going with the trust route, in 25, 25% of the companies are going with the trust route. Why the unlisted companies is preferring the trust route? The reason is simple that whenever the company is not forcing any exit opportunities for the employees or not seeing any liquidity event to happen to give monetization of the ESOPs granted to them, so the trust can buy back those shares and give monetization event to the employees. Whereas in the listed space, we can see the trend is similar and the trust route and the direct route gap is being narrowed, where 52% of the companies is going with the direct route and the 48% going with the trust route. Why? Because sometimes in the listed space, the promoter is not wanting to dilute their shares, does not want to dilute their shareholdings. So the trust route can actually acquire the secondary shares from the market and create the ESOP pool for the employees for the purpose of ESOPs. And also the trust route brings very efficient administration in terms of the management of the plan. The trust route also provide the cashless facilities to the employees where the shares can, to recover the exercise price and the perquisite tax, trust can actually sell those shares in the market and provide the remaining balance to the employee's demat account. So these are these are some of the advantages of the trust route. That is why the company is moving towards the trust route. Talking about the source of equity, so basically this slide is very much linked to the previous slide. If the company is moving towards the trust route, then the share of source of equity should also be different. So in unlisted space, we can see that the source of equity from transfer from promoter and existing investors is increasing year on year because the companies are moving towards the trust route, and the transfer from promoter existing investor can only be possible through the trust route because the secondary shares can only be acquired through the trust route, not the direct route. Whereas listed space, we can see that most of the companies go for fresh issue, that they want a primary issue and the company manages the plan. But we can see an increasing trend in the market purchase of shares, that is the secondary shares, where the trust can acquire the shares from the market and create the ESOP pool and not diluting the existing shareholding pattern. So this is all about the vesting condition trends. We have seen that in this year's survey, in unlisted space, time-based vesting is the most dominant approach opted in the unlisted companies. Whereas in listed companies, performance-based vesting is the most preferred method to grant the options. The reason is very simple because in unlisted space, time-based vesting, you have to grant some of the options while being time-based because the employee doesn't see any wealth creation on a daily basis. They don't have any track to see how they have value created and how much they have created out of ESOPs. So it is very much essential to grant time-based vesting in unlisted space. In listed space, company is looking to have a measurable outcomes while granting or rewarding the employees. So the performance-based proportion is larger in the listed space. Also, in unlisted space, companies are following the hybrid structure like time and performance-based. It is very much essential that some of the options would be time-based and some of the options would be performance-based because the more employee will associate with the company, the more he will get the ESOPs. And if he performs well, then extra options he will also get in this kitty. So that's it from the India perspective. I like to close my part with the closing statement that as we all aware that the common mindset about ESOPs that it is a tool for reward and retention. But in Capita, we see this as a very limited view. It's just not a tool for reward and retention, but a strategy to unlock the power of ownership and creating and sharing the company's success with the people who are actually contributing to it. Right. So now I would like to welcome Mr. Mitan Patel to educate us on the global practices around equity compensation.
Welcome. Good morning, everyone. It's great to be back in India Sorry, that's me being trigger happy. There you go. Great to be back in India today, and thank you for Ravi and team for inviting me. Equity compensation is a very, very fantastic topic for me to talk about. If anyone sort of got the intro, and thank you very much for that. I actually started off life as an engineer, aeronautical engineer. So to come into this equity space and to do it for 25 years, there's a lot of passion around that process. Now, I come with two hats. So I've got the hat of talking about the Global Equity Insight Survey that the Global Equity Organization, which is a non-profit organization, produces. But I also play in the equity space, and my other role, my day job, is I'm the global head of market development and partnerships at Fidelity. So today I want to use those two insights to really talk you through what we're seeing with the survey. Now, the Global Equity Insight Survey has been running since 2013, and I would truly say, as a non-profit, and what we do is try to promote share ownership around the globe, we wanted to have a survey that helps our members, our customers, and also helps us with the regulatory and other bodies to actually promote share ownership in the world. So we started in 2013, and for 13 years we've been providing, on an annualized basis, collecting data that is helping us with that mission and that goal. The core of that has been always LTIs and SPPs, share purchase plans. We always ask questions and promote around that process, but what you'll see is other topics that we've been talking about throughout that life cycle, and we wanted to always be current. So as an example, when there was growth from our members to say we want to introduce plans in Asia, in China, we worked with those companies to get data and information so we can make sure we can promote that not only for the companies themselves, but their employees. During the pandemic, a lot of you would have gone through this process, and some of the questions as you were sitting there saying, what are other companies doing? What are best practices? We wanted to capture that information and share it with you. And today I'll talk about two areas particularly that we're focusing on right now, and I'm sure there'll be some conversations throughout the day. One is AI. I think I've spent the last 18 months at every conference I go to and talk about AI, and I want to talk a little bit about how companies are starting to utilize that, especially in the equity space. You hear a lot about it in a lot of different sectors, but equity and how companies are thinking about it. And then we'll talk a little bit about the private market. I'm not going to ruin the keynote speak in a minute. I got introduced to Pramod, so I'll leave that to him, but I will sort of touch upon some of the things that we're talking about there. Now, what do we cover? So during this period, we typically talk to about 200 companies that give us results. They're purely based in North America, which consists of the US, Canada, and some companies in Mexico. We have a huge European range. You'll think of most of the countries from UK, Germany, Netherlands, Italy, France, most of the Nordic countries. And we do have some companies from the rest of the world, India being one of them. We have Australasia, Japan, Hong Kong, and some Singaporean companies as well. Now, typically, the coverage of this is around 11 industries. And today, I'm really going to be honest with you, you're going to see a light touch. The total presentation, and Ravi hasn't given me this much time, is around 250 slides. And I've got a snapshot of about 11. So I'm going to try to cover what I think is very relevant, what came out from the survey. But also, the last, I would say, 6 weeks have been very, very interesting in this space from a global perspective. And I'll share some of those highlights with you today. So let's start with long-term incentives. And I think when we think about long-term incentives, this has sort of been the core of equity compensation since the outset. We've got about 177 companies that gave us information on this. And I want to share a couple of highlights before I dig into a little bit of, say, compensation mix, and also talk a little bit about what sort of equity has been offered from a global lens. So the first one has been really interesting. Over a period of time, everyone tells you what equity they give, what population do they give to. We've been very interested on this question, the cost to serve. Because all of you out here that give equity and give value, at some point, I know I've sat in front of many CEOs and CFOs and said, is this actually working? Are we actually creating wealth creation? And what does that look like? On the flip side of that question is, how much does it cost me to run this plan? You're spending a lot of money. Administer it for less. So over the last 2 years, we've been asking that question, and I'd like to share right now the average of those 177 companies spend around $400,000 externally on administration. Now, don't get me wrong, that could be administration providers, that could be taxation, that could be compensation, so there's a big mix there. And next year we want to break it down. But in addition to that, we also ask the question, what resources are you using internally? And the average is 3 full-time headcount. It doesn't mean that one person is doing equity all their time, but as you all know, there's a lot of stakeholders in your organization that add to this piece. So when we're talking about these companies, when you add that to a US number, that is shy of annually $1 million in expense to run this. So I wanted to share that because I think that's a very interesting fact. The second fact that came out of the survey is around communications. I think over the last, I would say 5-6 years and over the pandemic, communications has changed dramatically. And it was great to see, the capitalist there where you were talking to employees about educating them and giving them that knowledge. I think that's changed a lot. But again, another fact that I found quite fascinating, 1/4 of those companies that we survey outsource their communications. They don't do them themselves, which again, I think it's a growing trend. I always say no communication is bad communication, and that will have a direct impact on your plan. But more interestingly, 39% of those companies are based in North America. So the reason why I share that is always in the US, you start to see the trend, and then it catches the globe slowly. So again, I think that's something for us to see. Now, let's talk about my favorite topic. What does it look like outside of India when you're looking at the US, Europe, and rest of the world on equity compensation mix? And what this graph is showing you is, on the right-hand side, you're talking about the management boards, the C-suite, all the way down to executives, down to the rank-and-file employee. And it might not be very clear to see, but what it's actually showcasing here is, in terms of long-term incentive, that makes a large proportion in the United States of their compensation mix. It is almost gathering close to 50%. Now, the reason why I share that, something amazing and crazy happened on Thursday, the 6th of November. Does anyone know what happened? Let me share it with you. There was an AGM in Texas. It was Tesla Motor Company. And the most craziest thing, but the most fantastic thing as a practitioner, and for all of you here, should be looking at, they decided to grant their CEO, Elon Musk, $1 trillion as an equity compensation package. That's right, $1 trillion. It was a performance-based plan, so it made me quite excited, and it's got a number of triggers that actually releases that equity to the individual. Now, I'm not excited for Elon Musk to get a trillion. I think if he achieves that, that'll be fantastic. It's a great promotion for equity compensation. But actually, what people didn't think about below that is one man doesn't move a company. So what people aren't talking about, and over the last 6 weeks, I and other people around the industry have been talking about how much equity is going to go down to the other populations to create that wealth. And surprisingly enough, some of the early information that we're hearing is they're looking to grant around 2.5 trillion to those other employees in Tesla. Now, 2 weeks ago, I was speaking at a conference like this in Las Vegas. Next to me was a gentleman of another EV car company called Lucid Motors. And I said to him, Matt, are you busy? And he's like, I'm crazy busy right now. And I said, what's going on? He's like, well, first of all, my chief executive has seen the package that Elon's getting, and he wants to get paid more. So I have to figure out and tell him, we're not going to pay you $1 trillion, but what do I get paid for more? So the best way of benchmarking, and I know all of you spend a lot of time and money doing it, is just get your CEO up there and give him an award, then everyone else knows what the benchmark looks like, and then they can go from there and say, how do I work for it? So there's a lot of executive folk right now looking at what they should get paid. And by the way, that's not just in the US, that is very global. The second is, if you didn't think there was a war for talent, for tech resources, it has absolutely just started. Can you imagine now if you are now in an organization that is going to release, potentially, if you hit your performance conditions, about 2 trillion? It's not going to be too hard to actually get that talent to come for you. And by the way, these aren't the people that are buying motors, these are actually tech individuals. So as you start seeing this, you're going to see this across the United States, all across the globe, and I think it'll have a meaningful impact in India. But there is a good news story to this. There's a lot of wealth creation to happen if you can get this right. So exciting times around that process. Now, let me just talk a little bit about what type of equity plans that have been sort of offered against this population and what do these companies offer. There's two standard and most used are performance share plans, and I think these will continue to rise, especially if I go back to that Elon Musk piece. When you look at the performance conditions applied, it's like robo-taxis, giving robots. It's not, hey, deliver X cars. It's actually going down to technology. And what you'll see is a lot more individualization on performance. So that's to come. There's still a lot of uses of restricted stock units as well, and stock options. Stock options predominantly, a lot of use in North America, but again, I sort of see the return of options coming to Europe as well. So that'll be quite exciting to see what happens there in that framework. So let me move on to stock purchase plans. And stock purchase plans are quite exciting in its own right, but even this year, we found some interesting elements that has a little bit of concern. Ravi, in your speech, you sort of said there's a lot of stock purchase plan and that was growing itself out. I can tell you that's the counter, what's happening in the North American space and the European space. A lot of it is really the impact of share price volatility, and that's what we're seeing around it. I know there's a lot of focus, I'll talk about the US, but there was one thing that impacts a lot of this, Trump tax and what's going to happen around that. So companies are being a little bit more cautious. Now, the natural effect is when you see volatility, employees think about what should they do. And naturally, when you're seeing that, then you might actually resist from putting down that process. So what we've also seen is the actual savings that individuals are putting in has reduced from 7% to 5 to 6%. So people are putting less into these equity plans. So it's quite sad, and we need to sort of think about how you sort of normalize that. But also what we're seeing around the world, a lot of regulators, just last week when I was in London, they announced a budget on the 26th of November. There is more taxation going to get paid. Two, if you guys aren't aware, there is an EU directive coming in on the 7th of June next year, which talks about trade transparency and what does that look like. And again, it doesn't mean if you are just a European company, it applies to every single company. So when you start thinking about some of these things, employees will have more access to understand about their compensation, as well as to go, how are they spending it? So I think that's going to have a very interesting dynamic as we move on from there. But let me just sort of give you a little bit of statistics of how people are structuring these plans outside of India. So first of all, you'll see there's a lot in the US around discount-based plans. They actually have a regime called 423B, which allows you to have a tax break if you hold the shares. So naturally, you'll see a lot of the US companies adopting that and having that discount approach. One of the things that I do like about that approach is to counter volatility, these plans are short and sweet. They actually only sort of have a quarterly period. You buy shares, and then you can sell them straight away. So when someone talks about ownership, actually what you're seeing is small ownership, right, with a small o, but wealth creation that builds off that. So that's the dynamic, and I think that's working really well. Counter that, if you look at Europe and what that graph and chart is showing you, Europe tend to favor share matching plans. So they'll have, you purchase some shares, if you hold them for a period of time, you'll get an equivalent match, and that works for it. When you really look at the dynamic of that plan, that is really looking at ownership and more around retention than anything else. And in certain countries, like for instance the UK and Spain, there are certain levers that you can pull, that you can buy these shares of pre-tax, and again, creates a lot of ownership. In the UK particularly, one of the plans that they launched was in the year 2000. So this makes me laugh because there's a lot of ownership created. If you invested in that plan right now, and today, if you had just a 2% share price rise, those employees are sitting just shy of £500,000 worth of shares. Now that makes me smile, but it also actually worries me because there's a single share concentration risk. And again, I think people need to think about what they do with that and how they leverage that part of that process. The other thing which I wanted to share, and I would say for the last 3 years, I talk passionately about share purchase plans. I think every company should have it. Employees should have the right to purchase shares in their organization, and they should do it with ease. And then the startup revolution happened. And I would sit there in front of CEOs, CFOs, heads of HR, and have this conversation. And they'd be like, what? It takes 6 months to launch this plan? And then payroll has to do what with what, and then have to purchase. Can we just not give them free shares? So the reason I want to highlight that is the biggest growth we've seen, especially with startups, and what you'll see there is free shares. Companies are now also going, hey, if I'm going to do all this work, I'll rather just give them free shares, put some performance conditions, and I can give them to them next week, because it's all about speed to market in some of these sectors, and they want to work really quickly. So AI. What can I say about AI? My early days of AI is watching Terminator. For all of those you will watch it, and John Connor's going to be back with equity. And I laugh about that because I really sort of thought to myself, are we going to see much AI in our space? And how quickly is that adoption rate? Now, funny enough, again, Ravi, you mentioned this in your speech with your tech stack. A lot of people in the administration space have always been using AI in the background. We've never really talked about it. It's just something you did. Great operational excellence, and that's what you delivered. But 2 years ago, I was sitting in a conference like this, and I said, who's using AI? And no one put their hands up. And then very slowly at the back, this one gentleman puts his hand up. And I said, well, what are you using AI in? And he eloquently went into this long speech, which all of us went, wow, I don't know what you're even talking about. And he did happen to come from Microsoft. So it showed a little bit that the future was here. So 2 years later, I was in Prague at a global equity organization conference, and I asked the same question. And would you believe every single person in the audience put their hands up, and they were using some level of AI in the equity space. Now, the reason why I share that is I think that's exciting in a certain piece, but the first stat I wanted to highlight is you've got individuals, and I think it's a 47% think that actually using AI will help with the human interaction and reducing it against pay-related decisions. So that's really fascinating, right? Over a period of time, 50% of this room will think that if you have an AI engine, that's going to make your pay job really easy. Now, I'm an optimist in most cases, but when you're thinking about this, how do you know the human behavior of what they want to get paid? And how does that work? So there's got to be a lot of data that works into that process. The other thing that we're seeing a lot of is around chatbots and communications. I think that's revolutionized some of the things that I've seen. Now the ability to have custom communications to your various generationals in multi-languages would have been a crazy expense. Now we're seeing that being utilized more and more. And again, when we look at that, it really becomes a really interesting factor to say, what will that happen as we sort of move forward into that regime? Now, the final thing I wanted to share, and when we sort of talk about AI, and I'm sure we'll talk about it in a little while, is how easy and effective is it to use? And I think that will spend a little bit of time. In anyone's of your organization, if AI is a hot topic, I can tell you equity compensation is not on top of that list. It's somewhere, but it's not on top of that list. So how do you make sure that you're relevant and you can access those tools itself? Just a quick stat to show you around that. And again, what this is really showcasing here is where would you use these advanced technologies? And really the clear winner is peer and industry analysis to actually help benchmark. So we'll see a lot more of that in the coming future. Oops, sorry, I've gone one too quick. And I wanted to just quickly sort of end with private companies. Now, private companies have been a really interesting growth story. So one of the things that we are seeing a lot more in the UK European space is private companies are staying private a lot longer. So I'm sure Pramod will talk a little bit about secondary markets and what will happen around that. But that's a really interesting fact. Now, what's really interesting around that, if companies are staying private a lot longer, then how do you release equity? So secondary markets play a good news story around that. But where I wanted to also highlight and sort of talk a little bit about is the IPO markets themselves. India is such an amazing success story. Outside of anywhere in the globe, India is the place to be. If you're here and you IPO, you've got a great market. That's only secondary to the US. And when we talk about the US in that sort of place, you're expecting all of those markets to tend to that. Now, we're even seeing that in Europe. Companies are now considering when they decide to IPO, if they've made it, they're not using London or Frankfurt, or if you're in Asia, Hong Kong, or Singapore, they're going to the US. So the US is now creating this mega structure, this mega market to play itself out outside of India, because they've done a great job around it. And I think as you start looking at companies and they're seeing their growth platform, I think that's going to be really exciting and really interesting to work around that. The other thing, because companies are staying private a little longer, they're having to go and put their hands back into their pocket and grant extra equity compensation rewards as part of that process. Now, the reason I smile about this is I'm sure that's going to be happening in the next 6 months, because guess what? If you are in these startups and you're looking at that growth piece and suddenly the Tesla HR acquisition engine is out there, the only way you're going to retain these individuals is by paying them more stock. So I think that has a sort of interesting loop around that sort of setup and that story. So I'm going to pause there, and I think I'm going to ask Edison to come back onto stage, and we're going to have a little bit of a conversation. So thank you.
Okay, yeah, so thank you, Mitan, for the insightful presentation and giving us new perspective around the equity composition for the global practice. So as you mentioned in the LTIP slides that the LTIP administration or the plan administration is becoming more cost intensive and require as well as internal full-time employees as well. So in your view, what the companies can do to adopt any new technologies or to transform anything to reduce this cost while the plan becomes scalable in the future?
Look, it's easy to go and say what you can do around it. I think we've got two issues, first of all. Why is it being so complex? And a lot of that driver of complexity is really taxation and regulation. So we need to push that a little bit, and that's something we don't have control of. I would tell you right now, if you took a snapshot of last year to this year, there is around, can you hear me? Yeah, sorry. There's around 14 countries, mostly in Southeast Asia, that are now actually asking and demanding for more information for those executives that are based there to make sure the taxation has been collected. So it's not that anything's reducing. I think having a robust system helps. Hopefully some of these AI technologies get into our space and they can sort of reduce cost around that. But I think sometimes when I look at this, the plans and what we want to put into place, you can actually make them a little bit more simpler and easy to use. And I think sometimes we almost sort of make stuff a little bit more difficult for ourselves in that downstream effect. So as I say, look, use of new technology, make sure you're adopting it. Simplify data, because I think everything revolves data around our setup. And the third one, just simplify communications. If you think you get 3 of those right, costs will naturally drop itself.
Right, the effective communication and the use of AI adoption in the plan administration will cut down the cost.
Yeah, and look, just think about your own companies itself. You might have at least 3 or 4 generational workforce into it. I'm fascinated of what I see at maybe sort of the individuals, like the baby boomers and so forth, the level of how they want information. Then you've got Gen X, Gen Z, and Gen Alpha is coming to the workforce. A, they don't want to speak to people. 2, they just want everything done on a mobile device. And 3, they don't want jargon. So when you start doing that, I think independently outside of what we're trying to do as an industry, the consumer, the employee is actually changing us anyway. And I think over time, if you adapt to those things, I think you get to the end goal quite quickly.
Yeah, rightly said. So as you mentioned more about AI in the conversation, so what do you think that the predictive modeling, what impacts predictive modeling can do in the designing the equity composition for the executives over the next 3 to 5 years?
So can I answer the question and say, if we get it right, what does it do in 3 to 5 years, right? Because sometimes you want to ask the question of going, where is it you getting to, and what does utopia look like? Think about what does that actually mean. If you take the ingredients of what you're trying to achieve, you're trying to get a level of benchmarking information into the system. You're trying to get competitor analysis of what does that look like. You're trying to understand what those stretch goals are. And actually, when you put it down to simplicity, a part of anyone's P&L is salary and expense cost. And how do I optimize that to get the most value of money? Now, if everyone's doing that, and please think about this, it's thought-provoking, and if someone's got an answer, please do reach out to me. if everyone does that, do we all end up in the same place? That actually we aren't working for different companies. Does the data set just tell us that everyone, if you're this level, gets paid exactly the same?
Right.
And I think that becomes really interesting. So as much as I like the fact that there are AI models and we want to get there, that also has to be some internal models that you want to adopt to actually go, how do I want to change my competitiveness? How do I want my business growth strategies to work? How do I want to look at my product against the competition, and how does it differentiate? And I think that will have a very interesting place, not just from a marketing perspective, but when I talk about marketing, also marketing new talent or your existing talent to retain them as well.
Absolutely. So it should be more specific. We can use AI at the overall level, but we need to align within the organization to be more specific, what suits best for the organization.
Yeah, and you know, people don't talk about this a lot, but you using AI engines and you're using a lot of data
Right.
cost a lot of money.
Absolutely.
It's not easy. And what you find now with AI engineers, like there is not a lot of them. So to build some of these models out, again, it's fighting against that resource. So as I say again, you know, a number of companies that I've spoken to, they would love to get some of these projects off the ground. Their company's got other ambitions, and that's where their resources are being used. So I think it'll be also a challenge to get that sort of resourcing available in the short term, at least anyway.
So, okay. On SPP, you mentioned in the slide that now the companies are investing 5 to 6% of the base salaries in SPP. So considering the volatile market, and especially in Euro where the admin cost is high, how the hedging mechanism can be used in the companies to actually mitigate the risk of fluctuation in the market and
A number of ways. I don't think you'll like the answer. I think one is like look at the model itself. I think at the end of the day, if your plan is a purchase plan and you're buying in an open equity market, then you have to buy and understand the open equity market and be available to go and do that. Like I said when I was explaining that segment, I think share concentration risk is where the problem lies a little bit to this. If you're buying in an average on a monthly basis, as an example, then you're averaging the acquisition cost. And again, if you allow the individuals then to sell, then you've got that piece around it. In terms of hedging, I have seen plans that do that. If any of you are aware, in France they have something called a leverage plan. And the way the plan works is the individual buys 1 share, the investment house buys 6 shares, and they go and purchase. The hedge onto that is basically at the end, depending on what the gain is, you get part of the gain and the company. So that takes that risk away. But that allows, if you think about that plan, even explaining it is really complex, and the
Right.
average employee won't understand it. So for me, I think the way you get around it is frequency of purchases and the ability to actually divest those shares actually puts people in a better position, because the impact and what we end up seeing is if you've got holding periods and there's a downturn in the marketplace and you can't sell shares, that's when the employees get panicked. And that's when they don't have access. So I would say that's the strategy I would actually say an employ and deploy itself.
Okay, so in that manner, that on the taxation part, what do you think that, what practical steps that the organization can take to actually simplify the tax burden over the employees, especially in the multi-jurisdiction scenarios where the plan is implemented globally and employees is around the globe?
Is there anyone from the tax office here before I answer this question? Look, it's a cat and mouse game. And when I said last week it was the UK budget, I actually was with the UK Treasury afterwards, and I just said it'd be really great if you just had a rate for ESOPs. And if you can work with your tax partners around the world and just have a similar rate, then it'll be so easy for all of us, and it isn't. I think the challenge really here is, look, education. I don't think we do enough of it. I think we mystify tax, and I always laugh because as you're educating people and you say you've got 1,000, rupees of shares, and everyone's super excited, and then you have to tell them, well, actually, you don't get 1,000. You have to wait 3 years, and this is what you get. Why don't you just tell that from day one? You don't tell them what the outcome looks like. So when the outcome actually happens, sometimes even though the share price has grown, employees are actually, from a mental perspective, they're like, oh, I've lost money. I didn't know I was going to get this. So I think that re-education is really sort of quite important at the year. And then the final thing I can say is us as an industry, as a body, continue to work with the regulators. One, make sure there's tax breaks for these type of incentive plans so we can grow. And I think, a lot of countries have done that, and we should continue that straight message globally. And two, the secondary to it, make taxation easier and simpler so we can help them collect tax really easily, and the employee knows what they're actually paying.
It should be a long-term process, not.
When I started this 25 years ago, I had a lot more hair, so yes.
Okay. So the last question, just to summarize everything, that what exactly you foresee in next 4 to 5 years in the equity compensation model? Can we expect more bold performance-based structure like Tesla you mentioned, or anything, a specific industry which impacts much while implementing through AI or adoption of AI?
All of the above. The reason why I shared the Tesla story is it's real, it's active, it's happening as we speak right now. I had the pleasure of sitting on a couple of compensation committee boards, and they're actively talking about it. And if they're actively talking about it, it's things that they're worried about and the way to figure it out. If you talk to advisors, they're being asked the same question, which is, will there be an impact because Elon's getting paid this money? Of course there's going to be an impact. There'll be an impact to all of us as we go downstream into it. So I would like to see how that plays out. I'm not telling everyone it's going to be a quick, rich scheme. So any of you sitting there with your HR hats on, it's still going to be a very difficult conversation to go into your finance team and say, hey, I want another 200 million so I can pay my employees. But it's those business cases that you will have to work and write to work around that. Now, that's one. The other thing which I am excited about is, look, as much as I sort of said the adoption of AI and technology is going to be slower, it is being adopted. So that is, interestingly enough, itself. And I'm not also talking about this in, hey, does Capita do it, do we do it, or does other people? I think it's happening all over the place. I was with some tax advisors the other day. They're utilizing it to manage tax rates and being more efficient with it. They're doing document storage around information to say, when did the tax regime change? So now you're not looking at all these documents. You can say, when did all the tax regimes change? And I've got an employee from this date to this date. It'll actually tell you. So tools like that are getting sophisticated. Think about communications as well. Again, I think there's a lot of usage around communications. And two things there. One, when it comes to money, it's a strange topic. But I will say, you need to talk about money in the language you're comfortable in talking about. So whether you're a global multinational and your business language is English, at the end of the day, if you're Italian, you want to actually talk about it in Italian and work for it. And what I've seen are some really smart tools that have gone from digital communications to actually, you can call a call center right now and speak in Italian and talk about your wealth and your communications. And it's an AI bot sitting behind it. So I think that's going to be quite interesting and fascinating in a few years as we go.
To simplify the communication process and to simplify everything.
Absolutely.
So yeah, Mitan, that's it from the questions point of view. I guess many of the questions are from the audience as well, but I think we have summarized everything, and in the interest of the time, we can just conclude this session.
Thank you very much.
Thank you for your time. Thank you for educating us on the new perspective around the global market.
Pleasure.
Thank you.
Thank you for having me. Thank you, everyone.
Thank you very much for this insightful session. And I would love to invite Ms. Suvarna Kulkarni to felicitate Mitan on stage.